Welcome back to Investing Talk Podcast.
Today we're looking at AST SpaceMobile. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Mm-hmm.
This company is presenting one of the most polarizing situations in the market right now. Really.
How so?
Well, on one side, you've got this incredible stock momentum. I mean, truly amazing, fueled by a genuinely revolutionary vision.
Okay.
But on the other side, you have deep skepticism, like almost outright dismissal from institutional analysts. It really is the ultimate high-stakes bet on, well, flawless execution.
And when you say momentum, you mean momentum. The numbers are absolutely headline-grabbing. We're talking, what, over 300% this year in 2025 alone?
Exactly. Year to date.
And it recently closed near $73.70. I mean, when a stock triples, more than triples, in less than a year, that's not normal market behavior, is it?
No, definitely not.
So what's the catalyst? What's strong enough to drive that kind of triple-digit excitement? Is this just, retail hype, or is there real substance behind it?
No, it's not just hype. There is profound substance driving this. The main thing is third-party validation, a really big deal.
Which is?
In October, just last month, they announced a significant partnership with Verizon.
Verizon, wow, okay.
Yeah, and the goal is huge, launching space-based cellular services to remote U.S. areas, starting in 2026.
So direct to standard phones.
That's the plan. And for an early-stage satellite operator like AST SpaceMobile, this is absolutely critical. A deal with a Tier 1 carrier like Verizon, it's not just about potential revenue down the line.
Right, the stamp of approval.
Exactly. It's validation that the technology actually works, or at least that Verizon believes it will. And that massively de-risks the path toward, wider commercial use.
That Verizon partnership certainly sounds like the starting gun in a pretty high-stakes race then.
It is.
And the company claims they've got let's say, the vehicle needed to win that race. They focus heavily on their tech leadership.
They do. They have what they say is a highly differentiated competitive edge. Specifically, the hardware.
Yeah.
The satellites themselves.
Right, they're building the Bluebird 6 and 7 satellites now, aren't they?
Yes, actively building them. And these satellites, they're not just like incremental updates. They are fundamental to the entire business model.
Yeah.
They're described as having the largest commercial phased arrays ever put into low Earth orbit, spanning, get this, 2,400 square feet each.
Hold on, 2,400 square feet. That sounds enormous for a satellite. Can you put that into perspective? Like, what does that size actually do for them?
Well, that scale is everything. If you picture that array, it's roughly half the size of a standard basketball court up in space.
Half a basketball court, seriously?
Seriously. And that massive surface area isn't just for show, right? It's about power and bandwidth.
Yeah.
Lots of it. It's what lets them potentially offer truly effective direct-to-device connectivity. The whole point of their system, their big promise, is that you don't need a special satellite phone or some clunky new antenna.
Ah, so the signal is strong enough for my regular smartphone.
That's the core innovation. Strong enough to connect directly to the phone already in your pocket. That's the breakthrough that competitors like Starlink and Kuiper are also racing towards. And the sheer scale of these Bluebird satellites is AST's main differentiator right now, their bet.
It sounds revolutionary, genuinely. But revolutionary tech usually demands revolutionary amounts of capital, right? And this is maybe where we need to pump the brakes a bit.
Yeah, dramatically.
Because when we switch from the tech ambition to the financial reality, the picture gets, it gets foggy fast.
Exactly. We hit an immediate and pretty critical financial data gap. For a proper equity analysis, especially on a company banking everything on future milestones, analysts need transparency. We need the numbers.
And they're missing.
Well, critical recent data, specifically the SEC filings like the annual 10K report, the quarterly 10Qs, detailed balance sheet info, current debt levels, free cash flow metrics. This stuff is apparently just unavailable in the sources we could access right now for this analysis.
Okay, and just spell it out for us. Why is that lack of clarity such a huge red flag for you as an analyst looking at a company like this?
Because look, this is a capital-intensive early-stage operator. They're building massive, complex physical infrastructure in space. That costs a fortune.
Right, they must be burning through cash.
Absolutely. Just to get to a point where they might have a commercial product. So without those recent SEC filings, we can't accurately gauge their current burn rate. We don't know how much runway they have left before they need more money, or what the true cost structure of their deployment plan really looks like.
So investors are kind of flying blind on the financials.
Pretty much. It forces you to bet blindly on their ability to manage cash effectively, which is always a high-risk proposition, especially in the space sector. It's notoriously expensive.
And the financial data we do have access to, despite these gaps, it doesn't exactly paint a rosy picture in the short term, does it?
No, it really doesn't. The company recently posted a pretty significant loss, minus $41 per share in the last reported quarter.
Okay. And how did that compare to expectations?
Badly. It was a brutal 115.79% miss against the consensus expectation, which was for a loss of only 19.7 cents.
Wow. So they lost more than double what analysts thought they would.
That's right. Which suggests either their cost control, their execution, has been significantly worse than anticipated, or maybe their guidance to analysts was just way too optimistic. Hard to say which without more data.
And this wasn't a one-off, was it?
Unfortunately, no. This isn't an isolated incident. They actually have a history of falling short. They've missed analyst expectations in 3 out of the last 4 quarters.
Okay, that pattern doesn't exactly inspire confidence.
No, it reinforces that skepticism around their ability to hit future cost targets and, crucially, those deployment targets for the 2026 Verizon launch.
Which brings us right back to the money, to the capital issue. We saw them making some moves recently to address funding needs, didn't we? Something about repurchasing convertible notes.
That's right. They announced the repurchase of $50 million worth of convertible notes.
Okay, for listeners maybe not familiar, what exactly is a convertible note and why repurchase it?
Sure. So a convertible note is basically debt that the holder, usually an investor, can eventually choose to convert into company stock, typically at a predetermined, often discounted price.
Okay.
Repurchasing them usually cleans up the balance sheet a bit, makes it look tidier, and reduces the potential for future dilution if those notes were converted into lots of new shares. However,
There's always a however.
well, here's the interesting and maybe slightly concerning part. They didn't fund that $50 million repurchase with cash they had sitting around.
Yeah.
They funded it through something called a registered direct stock sale.
Okay, registered direct stock sale, meaning they sold new shares.
Essentially, yes. They sold brand new shares directly to certain institutional investors to raise that $50 million quickly.
So, wait, they issued new stock to buy back debt that could have turned into stock. What's the net effect there?
It cleans up that specific convertible debt liability now, but it does increase the total number of outstanding shares immediately. So it still carries dilution risk for current shareholders, just in a different form.
So what does that signal to you?
It signals 2 things, really. First, their capital demands are constant and pretty immediate. They needed that $50 million. And second, they seem to be prioritizing cleaning up the balance sheet now, perhaps to look better for future funding rounds, even if it means diluting existing holders a bit right away to fuel that big infrastructure build-out.
It really creates this fascinating contradiction, doesn't it? You've got this huge Verizon deal, incredible sounding technology, massive stock momentum.
Yeah.
Yet the analyst community, Wall Street, seems starkly bearish. The consensus rating from, 11 analysts is reduced? That seems incredibly negative given the news.
It is. They're reacting primarily to the financial fundamentals, or the lack thereof, and crucially, the stock price action itself.
Right.
I mean, look at the breakdown of those 11 ratings.
Right.
It's just 3 buys, 4 holds, and 4 sells. That is definitely not the picture of confidence you'd expect for a stock that just shot up over 300%.
So what's Wall Street saying here?
They're essentially saying the stock has gotten way, way ahead of itself. It's pricing in all the future potential, the perfect scenario, without properly accounting for the immense execution risk and the sheer capital cost required to actually get there.
And what's the concrete financial implication of that bearish view? Is there a price target?
Oh, yeah. And it's telling. The 12-month average price target from those analysts is only $45.27.
$45 compared to the recent trading price near $73.70.
Exactly. That implies a potential downside of 38.57% over the next year. That's a big drop they're forecasting.
That's a huge disconnect.
It is. And it's not just that the target is low. Look at the recent trend in sentiment. Over the last 90 days, we've seen 4 analyst downgrades versus only 1 upgrade. Wall Street is signaling very loudly, hold on, this price is too high. They believe the market is rewarding a vision that is far from guaranteed and is trading well above what the underlying fundamentals currently support, if they even support it at all, given the data gaps.
Okay, so if you're a listener maybe holding this very volatile stock, or maybe you're tempted to jump in given the hype, what should you be watching closely in then, say, the next 0 to 3 months? What are the near-term make or break points?
Yeah, good question. Two specific things really demand attention. First, the upcoming Q3 earnings report. It's scheduled for November 10th, 2025, so very soon.
And what's the key thing to look for there? Revenue won't be much yet, right?
Exactly. Forget revenue for now, it'll be minimal. Focus entirely on the cost side. What's the funding deployment look like? What's the cash burn rate? And crucially, are they showing any sign, any progress towards significantly reducing those big quarterly losses? Another big miss here could really panic the market.
Okay, cost control and burn rate on November 10th. What's the second item?
It's all about the technology schedule. Keep an eye out for any updates on the launch preparations for those big Bluebird 6 and 7 satellites.
Ah, the hardware milestones.
Precisely. Successful satellite deployment milestones are typically huge, bullish catalysts for space stocks. It proves they're hitting their timeline towards that crucial 2026 Verizon goal. Any delay, however minor it seems, will likely be viewed very harshly, pushing potential monetization even further out.
Okay, so if we try and synthesize all this conflicting information, the amazing tech, the huge Verizon deal, the massive stock surge, but also the big losses, the data gaps, the analyst downgrades, what's the overall investment horizon look like for someone considering the stock? Is it a buy, sell, hold?
Well, the overall assessment really has to be framed as a speculative bull case, but with a very, very guarded outlook. If we had to rate it, maybe a 5.5 out of 10.
Okay, so lukewarm at best.
Yeah. It's definitely a higher risk, potentially higher reward kind of proposition. For short term, tactical trading around those specific catalysts we just mentioned, earnings, launch updates, maybe it's moderately attractive if you thrive on that kind of volatility.
But for a typical investor,
Fundamentally, this stock seems best suited for long-term investors.
Mhm.
And I mean long-term, like a 3+ year horizon. And crucially, only for investors who can genuinely tolerate significant risk, maybe even the risk of losing most or all of their investment. Because the clear path to actual sustainable profitability, it's still way off. Well beyond 2026, most likely.
that makes a lot of sense. Let's just quickly summarize the primary risks again, because they are substantial, and anyone involved needs to keep them front and center. Number one, you said huge execution risk on that 2026 Verizon launch.
Extremely high. Any technical slip-up, any delay pushes monetization further out.
Which leads directly to risk number two, dilution. Because that profitability timeline is so murky, they'll almost certainly need to raise more capital down the road.
Very likely.
Yeah.
Which usually means selling more shares and diluting the value for existing shareholders. It's a common story with these capital-intensive tech plays.
And the third big risk.
Competition. You can't ignore the giants in this space. You've got Starlink, run by SpaceX, which already has a massive working satellite network and is backed by, well, effectively near limitless capital from Elon Musk's ventures.
Right. A tough competitor.
And then you have Amazon's Project Kuiper, also backed by a corporation, Amazon, that can essentially print money to fund its satellite ambitions. AST SpaceMobile is maybe more nimble, a pioneer, but they are going up against companies that can outspend them probably tenfold, maybe more. That's a huge existential risk.
Okay, so pulling it all together, it's a compelling story, no doubt. The long-term vision, connecting the entire world directly with space-based cell service, that's potentially world-changing, a massive untapped market.
Absolutely huge potential.
But the short-term reality right now, today, is that the stock is trading way, way above where Wall Street analysts think it should be. It seems to be betting almost entirely on flawless, perfectly on-time execution over the next couple of years.
Which really raises the critical question for any investor looking at that $73 stock price, doesn't it?
Yeah.
Is the market currently rewarding a really compelling future vision, or is it rewarding proven execution? Because based on the financial data we have, or maybe the data we don't have, it feels like the market is betting very heavily on a future that hasn't happened yet. And, that's a gamble, isn't it? Not really an investment at this stage.